we'd like to welcome you guys to the 2019 Eide Bailly year-end seminar. On today's seminar, we have payroll and 1099 experts ready to assist you and your team to navigate the complex issues to have a successful year-end. Our presenters today are Kate Senso, who is our Payroll Service Manager, Jillian Robinson, who is our National Boss Senior Manager, and myself, Angie Ziegler, National Boss Senior Manager. As a group, we'll be going over topics that we believe will have the most impact to your year-end in 2020. New this year that we have not done in the past, we are having a full section on 1099s. So we'd like to thank Jillian for coming on this year to help us out with that. So based on all the material that we are going to be covering today, we did extend our seminar from previous years from 1 hour to an hour and a half. But we may not have times at the end for questions, but we do encourage you to put them out there. And if we don't get to answer them, you have all of our contact information right here. So you guys can reach out to us by email or calling us, and we can help you. Our slides today are based off information that we have that are current as of today. And so just please understand that sometimes the IRS does like to throw us a curveball and either delay something or change something that is going into effect. That what we have is most accurate as of today. So with that, we're going to get started with our agenda. For the payroll W-2 part is going to be the first part of our hour, and then the 1099s are going to come in for the last half hour. So just getting started, our agenda for payroll 2019-2020 updates. Kate will be covering extensively, which when she comes on the phone, this will be great because she knows all the rules for the new W-4 form that we're all excited about to see and hear about. We have our W-2 due dates and penalties, just making sure that you guys are aware about if we are not hitting those deadlines, that there is a high penalty with our payroll returns and our forms. And then, as always, the taxable fringe benefits. So this is something we currently go over quite a bit every single year-end webinar we've done with you guys. We try to reiterate and also add on some new things for you guys, but they are so important that we have to keep going over them.
So Angie kind of went over what we're going to be going over in this webinar. So I'm just going to jump right in here. As you can see, the Social Security wage-based limit is increasing again for 2020. The current wage base in 2019 is at $132,900, and it will be increasing to $137,700. The tax rates will stay the same at 6.2% for both the employee and the employer, and the Medicare tax rate will remain the same at 1.45% for both employee and employer on the first $200,000 of wages earned. But once an employee would go over the $200,000 and earn more than that, the employee pays the additional 0.9%, but the employer's rate remains still at 1.45%. With the retirement plans, there are a variety of retirement plans that companies can offer. We once again see an increase in the amount that an employee can defer into their retirement accounts for 2020. 401k accounts for 2020 will increase to $19,500. And this includes the 401k deferral and the Roth. And that's an increase from 2019, which the limit is currently at $19,000. The retirement accounts for the 403b, the 408k, which is also known as a SEP account, that will increase to $19,500 also in 2020. And the 408p, which is also known as a simple plan limit, is currently at $13,000 for 2019, and that will be increasing to $13,500 for 2020. If an employee is age 50 and older, they can elect to do an additional amount into their retirement account, which is called a catch-up. So for simple plans, the catch-up limit remains at $3,000, and the other plans, the catch-up limit is increasing to $6,500 for 2020. It's also very important to note that you know what your retirement plan document includes. Companies set this up, and they set it up to include certain wages that are included and certain earnings that are not included, and this can vary from company to company. So make sure you look at your retirement plan documents to know what's considered compensation in your plan. So if you're adding on those taxable fringe benefits at year-end or doing year-end bonuses, to know whether you should be including your retirement deductions in these additional payroll items that you normally wouldn't have throughout the year. Also note, excuse me, that there is a different codes on the W-2 in box 12. The 401k, the code is D. The simple plan is code S, and the 401k Roth is AA. For health savings accounts, they will also be increasing for 2020. For the self only, the limit increases to $3,550, and for family, it increases to $7,100. The catch-up, and that for the health savings account, that's if an employee is 55 and older. So don't confuse that with the retirement plan, where that's 55. That's 50 and older for the catch-up. HSA is 55. That will remain the same as 2019 at $1,000. The W-2 reporting for HSA is box 12, code W. And the amounts that gets included in this is the employee's pre-tax and the employer amounts. But keep in mind that the employee and the employer amounts go towards the limits for the year. Dependent care. The 2019 limit for dependent care is $5,000, and the flex spending account, which is your FSA, is $2,700. As you can see on the slide here, the flex spending account limit is.
All right, looks like Katie is having some technical difficulties with her computer. Angie or
Amy, I'll
Kelly?
jump in.
Okay.
I'll jump in on it. Okay, so as Kate was showing on here that the 2020 dependent care has remained the same at $5,000, and the flex spending account has increased to $2,750. We were just at a year-end payroll class, and they showed some possible upcoming court cases, and they showed that dependent care is being talked about increasing it to possibly $16,000, which seems like a big reach from going from $5,000, which has been $5,000 for a very long time, to jump up that significantly to $16,000. So it'll be interesting to see what comes out of that, but as of right now, 2020 is still remaining at $5,000. Okay, some other updates for payroll numbers is our transportation, qualified transportation fringe benefit. So parking expense, 2019 is $265 and 2020 is $270. This is estimated because they have not yet released this as of yesterday on the updates. And also combined value of transit passes, vouchers, tokens, or fare cards. 2019 is the $265 and 2020 is the $270, still estimated. This question came up is that most people assume you can have one or the other, but it doesn't actually state that. It says these things can be used together, and so you could have a $265 parking and a $265 maybe vouchers or tokens added to your non-taxable items for your employees. So what is newsworthy? So we have some big news coming up for our W-4 form. So if anybody's seen the draft, and yes, it's still in draft mode. We've asked some IRS people, are we thinking this is going to be delayed again because we're coming up so close to the end of the year? As of right now, they're saying no. So now we're getting ourselves prepared for software to comply with that, and then also for our employers to be able to educate their employees on the new form that needs to be resent in if a life-changing event has happened or if you have new hires. Other thing is EFTPS password reset. And then we have SSA notice no match and our white collar salary threshold. That actually has kind of crept back in. Back in, I think, 2017, they were trying to do a very aggressive increase to the weekly salary threshold. And now it's kind of coming up onto us with January 1 with the new rollout of this. Polling question. All right, so our first polling question is, what form is changing significantly in 2020? The answers are Form W-2, the Form W-9, Form W-4, or the Form W-8. All right, so the answer is the W-4 form is the one that's significantly changing in 2020. It looks like we had a majority of you who answered that correctly. I'm going to kind of lightly touch over the 2020 W-4 form because I know Kate's got the presentation on this, but I just want to make sure we keep moving with our presentation. So the 2020 Form W-4 is significantly changing. In fact, they don't even call it, they removed words out of the title, so the new name of this form is Employees Withholding Certificate, which the allowance part of it has been removed. In the past, our W-4 form actually has been set up more geared towards allowances, so you would claim single and zero, married and one, married but filing on a single with a one allowance. So those are the past W-4s. The new W-4 form is giving us dollar values instead. So the allowances have been removed. Now we're going to be doing a dollar amount. So here is the draft mode of the W-4 form, which we've been told it is going to become active come the end of the year to start using it for 2020. some of the questions that have come in for the W-4 form that we've been kind of watching is, you know, do all employees have to fill out this new form? And the answer is no. The employees do not have to fill it out unless they have a change of status. So if they want to change from single to married, having children graduate and move out, address changes, those types of things would require a new W-4 form. But you are required to give it to all new employees who are hired after January 1st. One of the questions that came in our class was, what if I have them fill out the paperwork in December of 19 for a January 1 start date? And the IRS came back saying that is okay, then you can still use the 2019 form. However, just know the 2021 is going to be going into effect. Why did they redesign the W-4 form? It was redesigned to comply with the income tax withholding requirements of the Tax Cuts and Jobs Act. So this was supposed to be released last year, and it got delayed. So then this year they've been working on it, and you saw on the previous slide that they had the draft there back in August, and it hasn't had any changes, but it is something that we are just waiting for them to take that draft out, so that makes it a live form for us. What steps are the form? What steps of this form are required? Because now we have 5 steps, and the only ones that are actually required are step 1 and 5. How do my employees claim exempt? Because in the previous form, there was actually a spot where you could write exempt. They removed that box, and what they're saying now is that under the box 4C, there's an open blank space that you can put exempt in. You can just write it in there, or if you have digital W-4s, they're trying to enhance it so that you can just type in exempt if your employee is going to claim exempt. Does this mean my payroll system needs to operate with 2 W-4 forms? And the answer to that is yes. So be very nice to your payroll software providers right now, because they are actively trying to make sure that both forms are supported in our software, because you cannot require, which is our next question, I ask all my employees to fill out a new form. You can ask. However, it is not required, so if they do not want to fill out a new form, they do not have to, and you cannot penalize them for this, and you have to withhold based off the form that they had in the past. All right, so the steps that we have to go through for the 5 different areas of the new W-4 form. Step 1, it's going to be the easiest part, employee personal information. So this step is going to allow the employee to put in their name, address, and if they're claiming single, married, head of household, and then they can just leave it at that. So once they fill that out, that's going to tell us what tax table to use based on the frequency of their payroll, and if we're going to a single or married head of household tax table. The step 2 is going to account for multiple jobs. So if you have, you want to add the wages in for your spouse. Okay, so the step 2 in this area, in this section, you have the chances to check a box. So now you're saying, I have a spouse who's also working, or claiming a tax return that's joint, and now if I check this box, I'm going to withhold at a higher tax rate than if I was just to fill in box in step 1 that I'm married. If I check the box, it means I'm married with a spouse who's also working. Step 3 is claiming dependents. So this is bringing in your income. So if you have $200,000 or less, with $400,000 if married filing jointly, they're saying add in your deduction for your children under the age of 17, multiply the number of other dependents by $500. So they're kind of walking down, trying to help you navigate your withholding to be more in line with how you file your tax return. So this is where it's asking more questions. Now remember, step 2, 3, and 4 are optional, and your employees could just fill out step 1 and then step 5, which is the signature. Step 4 is claiming other income. So you might have other income that's not having withholding. So now is your chance to actually have extra withholding come out of your payroll check that you hadn't had in the past. And then deductions, you can put out here the standard deduction, and you want to reduce your withholding. So there's a worksheet on page 3 that helps you claim the deductions to help you understand what you want to put on this. And then the last one is extra withholding. So you just want to put out a flat $50 extra, $100, your employees still have that option to do that. And then step 5 is the signature of the form. All right. Some tools that are out there to help you with filling out the form W-4 is the IRS has released a publication, 15T. This has all the income tax withholding methods and some of the tax tables out there. The IRS did do a webinar on the new form, and it's out there on the irsvideos.gov. And they actually have a tax withholding estimator, which they say if you used it last year, give them another chance, because last year they had some issues and some considerations that they didn't put into place. So they actually took the calculator out of this word and they put it as an estimator, just to make sure that people understand that we don't know all the facts that go into your tax returns for with your withholdings. So here's an estimator to help you determine what's the best withholding that you should have. Like I said, it's not going to be a single and zero anymore. It's going to be, I'm going to be single and I'm going to have $172 withheld each paycheck. It is going to physically give you a dollar amount. And then they have the FAQs on the 2020 Form W-4 on the IRS website. So we didn't cover all of them. We covered, you know, a small amount. But if you're interested in looking to see some of these that are out there, the IRS has given some guidance on other parts of this form. But just know 2020, this form is going live. Your system should be up and running. If they're not, have a conversation with those software companies to make sure they are going to be up and running. And then remember, you cannot force all employees to do it. You can encourage it, you cannot force it.
All right, it looks like we have Katie back. Katie, are you on?
I am now.
Awesome.
So with EFTPS passwords, to enhance security, the IRS has implemented a new policy that requires companies to update their EFTPS password every 13 months. Your password will expire 13 months from the time that you last changed it. And if a company does not update their password with EFTPS, their payments will be rejected and will be assessed a penalty for late payments. So keep in mind, if you use your software to electronically submit your payments, for example, like QuickBooks, we have a lot of clients that use QuickBooks. We've actually had this happen to a couple of our clients where their password did expire and they updated it through EFTPS, logging into their account actually, but in QuickBooks, their password did not get updated in there, so they processed their payroll and submitted their federal tax payments electronically through QuickBooks, and it looked like everything went okay. But since that password didn't get updated, EFTPS ended up rejecting their payment because it didn't match up with anything that got updated in their password change. So the client didn't notice it, and it resulted in an IRS notice, and penalties were assessed to them because their payment was late. So just keeping a mind of that is if you electronically e-file your payments through a software and not actually physically logging into your EFTPS website, that you'll need to make sure that those passwords do match on both sites. So if you remember in 2019, the Social Security Administration started sending out notices to employers who submit Form W-2 that contain name and Social Security number combinations that don't match with what the SSA has on record. The penalties for this are $270 per mismatch error. The SSA processes as many as 250 million W-2 forms each year, and they estimate out of that 10% of the W-2s filed each year have names and Social Security numbers that don't match with what they have on record. So for example, let's say your company files 1,000 W-2s. If 10% of them are wrong, that would make that to be about 100. And if you take that times the $270 penalty, that comes to $27,000 in penalties that you could be assessed just for having mismatched names and Social Security numbers. Some of the reasons that information may be mismatched: you have typing errors, unreported name changes, inaccurate or incomplete employer records. The Social Security Administration does make several attempts to try and match up the wages with the correct Social Security number before they would actually send out a notice. If they're unsuccessful, the wages are moved into what they call an earnings suspense file. And this suspense file contains all W-2 information since 1938. And they say that there are approximately 367 million wage records recording $1.6 trillion of uncredited wages in the earnings suspense file. So that's quite a bit of money that isn't accounted for anybody's in particular Social Security account. So make sure if you have an employee that comes to you and says that they need to update their name, that you are asking to see their actual physical Social Security card with the name change on it, and not just take it that they went to the SSA and got it all updated. You are able to verify Social Security numbers through the Social Security number verification system, which is through the SSA website. And one item to note, you are able to paper file with checking the box applied for on their W-2, or you can e-file with all zeros for the Social Security number, but you can still get penalized for doing it this way. You won't be penalized for it being late, but you'll be penalized for not having the correct Social Security number on the W-2 form. So something to keep in mind there. So moving on to the Department of Labor white-collar salary threshold. If you recall, back in 2016, this white-collar salary exemption was set to increase from $455 a week to $913 a week. And this was a huge jump, and many employers struggled with how are they going to handle this with the additional payroll expense, with it going from $455 to $913, with it essentially doubling. But a Texas judge came in at the very last minute and overturned the rules, so the salary threshold remained at $455 a week. This was once brought up again this year, and on September 24, 2019, the U.S. Department of Labor released the final rules increasing the minimum salary level for the Fair Labor Standards Act for the white-collar exemption. The white-collar exemption provides an exemption from both minimum wage and overtime pay for employees who meet the qualification. This new threshold for these exemptions will go into effect as of now, January 1st, 2020. The new salary increases put the white-collar salary at $684 per week, or $35,568 per year, which is up from the $455 per week, or the $23,660. Employers can use non-discretionary bonuses and incentive pays, such as commissions, paid on an annual or more frequent basis to satisfy up to 10% of the standard salary level. So for example, employers would pay exempt employees 90% of that standard salary level, which would be $615.60 per week, and up to the other 10%, which would be $68.40 per week, can be paid in bonuses or commissions. But keep in mind, if at the end of the 52-week period, so the calendar year, the salary paid plus the additional payments, if they do not equal the standard salary level for the 52 weeks, which is the $35,568, the employer would have a one pay period to make up the shortfall up to the 10% of the standard salary level, which is $3,556.80. So do remember, though, the salary test is only the first test in determining if your employee is exempt. The IRS does provide a question and answer section on their website in regards to this new threshold. So with this change, employers will have to assess their employees currently that are making between this $455 and the $684 per week to determine the best way to increase the employee's income. And there are a few options that they can look at that can be done to handle this. The first one, you could increase the employee's salary per week they earn to the new threshold of the $684 per week. Or two, you could have the employee or the salary employees be subject to overtime. You could continue to pay them their base salary each week, but any hours worked over 40 hours in a week would be subject to overtime. Or with this, you could just eliminate overtime hours altogether if that's a possibility within your company. Or three, you can make the employee hourly and just pay them for all hours worked and any subject to overtime. So in addition to an employee's wages earned per week, they also must pass the job duties test in order to be exempt from minimum wage and overtime pay. The FLSA has 3 exemption levels. They're the executive, administrative, and professional. So with the executive exemption, in addition to the salary basis of the $684 per week, their primary duties must be managing the company or a department or subdivision within that company. They regularly direct the work of at least 2 or more other full-time employees or their equivalent, and have the authority to fire or hire other employees. So examples of this would be like your CEOs, mid-level managers, or shift managers. Administrative exemptions, same thing, they must meet the minimum $684 per week. Their primary duties are to perform office or non-manual work directly related to the management or business operations of the employer or employer's customers, and they must be able to make decisions for the company. So example of these would be like your HR, tax, and finance. Professional exemptions, they're broke down into 2 categories. They're learned and creative. Learned professionals must be compensated, again, of not less than $684 per week, and their primary duties include work requiring advanced knowledge either in the field of science or learning. And examples of these are the people in law, medicine, or engineering. Creative duties include performing of work requiring invention or imagination in a recognized field of artistic or creative endeavors. An example of these are your musicians, your writers, or your actors. So remember, job titles do not determine exempt status. It is the duties the employee performs. And just to kind of follow up on this a little bit further with this exemption, if you don't classify your employees correctly and just make them salary for the sake of paying them and not having to track any hours for overtime purposes, it only takes one disgruntled employee to raise an issue that you, the employer, are in violation of overtime pay. If it's petitioned, you will most likely lose in this case, and more than likely, it will not only be that one disgruntled employee you'll be dealing with, it'll probably be several other employees, the way employees talk, and the way that they will probably dig into your record keeping of other employees as well. Remember, though, that this new white-collar threshold is the rule as of now, but it could change or be shut down again, so you just kind of have to keep your eye out for any updates prior to January 1st. IRS scams continue to be on the rise, and hopefully nobody on this webinar has been subject to any one of these, but they are targeting businesses, public schools, universities, and tribes as being sent this information. People are receiving what they call scam emails. This email looks just like it's coming from someone within your company. Their email address looks exactly like your company's. The signature line is identical. And that people have even said that if you have pictures on your email, that it comes with the picture of the person that you're familiar with, your CEO sending you the email. So it's hard to tell the difference between a real email and this fake scam email. Some of the examples of the email scams are the CEO of your company emails requesting you to send a copy of the W-2 forms for 2019 in a specific format, or you have an employee email saying that they changed banks and they need to update their direct deposit information for the next payroll, and this new bank account then is associated with the scammer. So if you would send funds to them, that it would directly go to the scammer instead of to the actual employee. And it's unfortunate that many people have fallen for these scams. They're just so busy with their work that they don't even think about it. They see an email, okay, yep, he wants that, and sends out the information that's needed. There have been $39 billion, and that's with the B, paid out to scammers in regards to fraud. So if you should fall victim to one of these scams, it's important that you notify the IRS, any state tax agencies, law enforcement officials, and as well as your employees. So if you're ever in doubt, double check with the person that sent the email, either in person or a phone call, to make sure that the request you received is actually legit. So let's talk forms now. Just a reminder that the W-2s due dates are still accelerated. Your W-2s and your 8922, which is your third-party sick pay recap form. The W-2s are due to the employees by January 31st. The 8922 form is due to the IRS by February 28th. And the due date to file your W-2s with the Social Security Administration is January 31st. And remember, if you have 250 or more W-2 forms that are filed, you are required to file them electronically, sorry. Also, please remember to look at your state due dates. Many states have adapted to the accelerated due date as well. Best practice would be to file the state at the same time as you do your federal. So what happens if you don't file on time? Obviously, they're going to assess you penalties because that's how they're going to make their money. So with these accelerated due dates, the penalties continue to increase for not filing correct information returns. We're seeing them increase every year. They've actually released the 2021 penalties, and they're once again increasing from the 2020. So if you file them within 30 days of the due date, it's a $50 return per return penalty up to a max of $556,500. If you filed more than 30 days late, but by August 1st, it's an increase to $110 per return up to $1.6 million. And if it's filed after August 1st, it's $270 per return up to $3.3 million. So these are costly penalties. But if they come in and decide that you intentionally didn't file, it is up to $550 per return with no maximum. So it can be very costly to miss these important due dates. So now I'm going to hand it over to Angie, and she's going to talk some more about the gross income and taxable fringe benefits.
Thanks, Kate. All right, so the topics that we're going to cover are the basics of payroll and then how it gets complicated. So what we want to make sure that you guys are aware of is we don't want you to get into a situation as you have your first audit, which is either IRS, unemployment, work comp, these audits that come through, that when they ask to see your general ledger, they're looking for taxable fringe benefits that you may have forgot to put on the W-2s. So that is where it gets costly to a company, is by missing those taxable fringe benefits that need to be taxed to the employee. So we're going to start off with our normal gross income. So gross income, this is the basic, hours times rate of pay. And then we're going to go into why it becomes not easy. So what we have, gross income, all income from whatever source, unless it's excluded by law. So we're talking all income you earn before taxes and deductions. So includes money, and sometimes people forget that it's not just money that they are receiving. It could be property if they get to stay at a company house, they rent an apartment for them, services, meals, accommodations, stock. There we go. All right, so when it goes from gross as hours times rate, that's our starting spot. And then we decide to bring in the next level of what's called taxable wages. Some companies, it's easy, gross is taxable. So they don't have any type of reduction towards their gross pay. The question we always get every year, and I'm sure everyone on this call has heard this at some point in their life, is why does my W-2 not match my final paycheck? So it is great to encourage your staff to make sure that they wait for their W-2 before they file their tax return. And make sure that they don't do it off their last pay stub, because not all pay statements show what taxable wages are. I know that some have gotten more advanced. The other reason to do this is when we do taxable fringe benefits, some of the items we put on are after January, or not after January, after December 31st in January, and that normally does not, that pay stub normally doesn't go to the employee. So if they're using their 1231 pay statement and we put taxable fringe benefits on after that, then they are not using the most current statement. So taxable wages, we take our gross and then we have deductions from our gross to make our taxable. So on this example, we have the employees earned $1,000 of wages, and then they have a pre-tax health and a retirement plan. So based on these two different types of cafeteria plan and a retirement plan, we're showing you how would this be reported on a W-2. So box 1 allows you to reduce by both a cafeteria plan and a retirement plan, but your Social Security and Medicare wage boxes do not allow you to use both. You only get to use the cafeteria plan. Box 16, which is our state wages, which we have some states that do not have state wages, but if you do, then it mostly follows federal. There's a few states like Pennsylvania, New Jersey that like to throw in other rules regarding cafeteria plan or retirement plan. But most states generally will follow the federal rule on this. So as we keep going into taxable fringe benefits, sometimes we're just wondering, what is a taxable fringe benefit? This is when payroll gets complicated. So we're going to go over the most common taxable fringe benefits and maybe a few things that are excludable to our employees. Not everything is taxable to our employees, but almost everything is taxable to our employees. So we're going to cover what are taxable fringe benefits and then very specific taxable fringe benefits. So things to consider: fair market value. It is what would it cost your employee to go to a store to purchase that item is what gets put on their W-2. It is never what did the company pay for it, because companies get things at reduced cost. Sometimes they get things for free and they turn around and give it away at the Christmas party. So what would it cost if I was to win a TV from work? What would it cost if I walked into Best Buy to buy that television? That's the value that needs to be added back to my W-2. De minimis fringe benefits. You still hear people comment about, oh, if it's under $100, $25, $75. There is no such thing on this. The IRS claims there's no dollar amount that is tied to a de minimis fringe. because the reason for de minimis means that it is hard to account for. It's unreasonable to be able to know who got the benefit, what the value of that benefit was. The things that we try to watch for with de minimis is words like occasional, not frequent. You cannot have someone who receives something like, season tickets and they get to go to every single game. That is frequent. They are frequently doing that. That's a taxable fringe. But if they occasionally get tickets to a sporting event, then we can say it's de minimis. Another one is, when they bring in the office donuts, coffee. If you randomly bring in a meal for your employees because they're working overtime and you want them to stay late, those types of things are de minimis to your employees. If you provide lunch to them every day, that is no longer de minimis because you are not occasionally doing this anymore. When are fringe benefits considered paid? You have to account for them at least once a year. Encourage you to do it more frequently because you have situations when you come to the end of the year that you have employees who are terminated. So now you have to put this on their paychecks, and you can't withhold tax for a person not getting a paycheck. And then the company is kind of footing the bill for that. Another thing that you want to be careful with is, once you come into the end of the year, it gets closer to the holidays, you hear more complaints like, you just taxed me on everything that I received through the whole year on my last 2 paychecks of the year, which then means that their paychecks are either a lot smaller or nothing. So be careful of when you do it, the more frequent you do it, the more employees can carry the burden across the year versus the end of the year. Special accounting rule, they put this into effect because it is very hard to get all of that information if we were to say December 31st was the deadline. So person use of auto is a great example of a special accounting rule where they allow us to end the benefit so we can run it from November 1 of 18 to October 31st of 2019. And then after October 31st, we then can assess what needs to be added back to that employee's W-2 for person use of auto. So they give us that 2-month lag from previous year into the current year. Depositing the taxes on fringe benefits, make sure when you put that into effect that if your tax filing is semi-weekly, it is still semi-weekly. So once you claim those wages on December 31st, you have to determine what day does that fall on to determine if you have a Friday or a Wednesday tax due date. So don't forget to make the tax payments. All right, W-2 loans to employees. So when does it become taxable wages to the employee? So if you were to give an employee a loan and then you decide to forgive it, at that point it becomes taxable wages to that employee. And then if you are doing a 5-year, you have a note, promissory note done up, and you decide you're not going to charge them interest, that's when it becomes W-2 taxable every single year, would be the difference of what you're not charging them for interest. So in the example here, we have a loan of $20,000. The company decided that they're going to do a small interest rate of 2%, but the federal interest rate is 6%. The income that would be added to the W-2 would be the difference between the 6 and the 2%, and you would add $800 of wages back to that employee's W-2 for the interest rate that you did not make them pay. Another thing we need to be careful with is loans versus advances versus draws. So advances are more random dollar amounts, not their salary. It's $100, $200 that you give them in advance, and then you withhold it over the next couple paychecks or the next paycheck. That is something that you don't want to see carry forward into other years, but you want to make sure that you're getting those advances paid back. But a draw, we had a situation that we were kind of watching that they had a big IRS tax fine that was assessed to a county based on they were taking mid-month draws on their monthly salary. The IRS came in, determined that that mid-month draw was in fact a payroll run, which they did not withhold taxes on. So then when they did their actual payroll at the end of the month, withheld the taxes, remitted the taxes, half of those taxes were 15 days late. IRS assesses very heavy penalties to payroll taxes that are paid late. So it ended up being like an $88,000 tax penalty over a 3-year span to this county. So make sure that if you are doing a monthly payroll and you do mid-month draws, that you change your payroll to semi-monthly, or you stop the draws and you put it to be a monthly payroll. So just make sure that you are understanding the rules of what is a loan, what's advance, and what is a draw. All right, employee discounts. So this one's kind of a new one that we're kind of bringing up to you guys this year. This exclusion applies to a price reduction you can give your employee. So the employee has to work for you, has to substantially work for you. So it can't be once a year part-time, just during seasonal timeframes. They have to have substantial hours with you, and you are allowed to give the customer or the employee a discount based off services that you also offer to your customers. So examples of this would be like a clothing store that offers you a discount to buy items in the store, or a hotel that you work for that gives you a discounted rate for hotel rooms. So the value of the employee's discount can generally be excluded from the employee's wages up to the following limits. So they put some limits on what can you give for a discount. So for a discount on services, 20% of the price charged to a non-employee customer for the service. So it can only be 20% lower than what you charge a customer for it to not be taxable to the individual employee. And then they also have a gross profit percentage times the price you charge a non-employee, so your customer, for the property. So those are the types of things that you have to look into, is what qualifies as a discount to your employees. And if you over discount it, it now becomes taxable wages to them. The exclusion does not apply to a highly compensated employee unless you offer the same benefit to every single employee. Then the highly comp employee can have the same discount. All right, so S corporations. So if you're an S corporation, this is where you really need to tune into this part. 2% shareholder, when we add back benefits, you are no longer an employee of the company. You are self-employed. So with health insurance, if the employer pays it on your behalf, we add it back to box 1 and 16 and we memo in 14. It is so important that you put it into the box 14 as a memo, because as we add this onto your W-2, we do not withhold federal or state from it. It is an increase to box 1. The box 14 is what's going to help you on your tax return to take it back out. So that's going to be your deduction. That allows you to have that deduction. So it's an in and out for you for health insurance that the employer pays. Health savings account is the same thing, employer paid. You do not get the box 12 code W. You are not allowed to participate in a pre-tax plan. If you are a 2% shareholder, you are not allowed to be in a cafeteria plan. If you have to pay any part of your deductions, it is going to be after tax. So the HSA would be added back to the boxes 1 and 16, memoing in box 14. Group term life. This one is a little bit different than how we handle group term life for the rest of your employees, which we'll cover in great detail pretty soon. But it is 100% taxable on the whole amount of the premiums that were paid. So you do not, as a 2% shareholder, get a $50,000 exclusion like the other employees do. You are going to be taxed on the premiums paid. One they don't have on here is disability, short, long-term disability insurance. It is not subject to FICA or FUTA tax. It is similar to our health and our health savings. If they pay your portion of disability tax, it is also just added back to box 1 and 16. Box 14 can get a little crowded, so make sure if you have other items going to box 14 that your 2% shareholder benefits are at the top, because those are required to be in there. Other items can be in box 14 for informational only purposes, but these are required. Our employer provided health coverage has not changed for W-2 reporting. So we are still in the same situation that if you had less than 250 Form W-2s in 2018, you are not required to put health insurance in box 12 with code DD. That would be both the employee and the employer portion added together being reported. But if you are below the 250, not required. If you are above 250, it is required. But if you're a smaller company, you can opt in to want to do it. You're just not required. If you have an employee who terminates that requests a W-2 early, you do not have to have that health insurance reported. And then if someone's receiving just health care benefits, so sometimes they're retired employees who the company is paying insurance for, they don't have a W-2 with actual wages, you do not have to provide them a W-2 for just the box 12 code DD. Third-party sick pay, as you set up the plan, make sure you have a conversation either with, if you have a payroll provider or if you have somebody that can give you some guidance, because setting up the plan is really important for third-party sick pay. It helps you determine who's going to do the W-2 reporting, who's doing the 8922, who's paying the taxes, the third party, is it yourself? So all that stuff comes in when you set up the plan. Third-party sick pay is a great benefit for your employees, but for payroll providers, it's kind of an administrative nightmare. So just be ready for third-party sick pay. One of the things that is kind of the headache of this is 12/31 comes, the third-party sick pay is not required to give you their statement until January 15th. So if you're wanting to get those W-2s out by January 10th and you have third-party sick pay, you cannot, because you do not have the last statement. You can call and ask for it, but they are not required to give it to you until the 15th of the next month. So how are these disability checks taxed? So if the employer pays the premiums for you, you don't pay tax until you go out on a leave and go on third-party sick pay. Once you start receiving a benefit, then you start paying the taxes when you receive the benefit. If the employee pays the premium, so let's say the employer paid and they turn around and put it back onto the employee's paycheck at the end of the year for the premiums, then when the employee was to go on a leave of absence, they would not have to pay any taxes at that time because they've already accounted for them in their wages on their W-2. A reporting requirement to come in with third-party sick pay is making sure you're reconciling your 941 tax payments and W-2 reporting. There is a spot on the W-2 that you have to check the box that says third-party sick pay. And then also the Form 8922. It's a third-party sick pay recap. If your third party is doing the W-2, you, the employer, have to file the Form 8922. If you do the W-2 in your office, the third-party sick pay will have to file the 8922. So just understand which one do you want to do and making sure that you have that prepared when you set up that plan. The fringe benefits on awards and prizes. This is the one where you are just trying to be a really great employer, give your employees rewards for working hard, have fun at their job, and then the IRS comes in and says, that's great, you're doing that, but it's taxable. So items that we want to cover that are taxable, and then there's the two that are non-taxable to your employees, but if handled incorrectly, could become taxable. So the amounts that need to be added back to your employee's W-2, if you give them any type of gift card, that is always a cash equivalent, and it is taxable to the employee. If you have a company or a Christmas party that you have gifts or you have prizes that people can win, those are where you can, the de minimis rule does not come into play. You usually draw someone's name out of a hat, you announce who's getting it, they get to win the TV, as we said before, and now you have the person, and we can find the fair market value of that. Now it is practical, and we can tax that individual on that prize. So the items that are not taxable, we have our safety award and our length of service. But you have to abide by the rules that less than 10% are eligible for safety awards. The employee has to be full-time and has to be working for 1 year. And managers, professionals, administrative, and clerical are not eligible for a safety award. However, if you give a safety award a gift card, it is now taxable. You have to give them a tangible gift. Length of service, same thing, tangible property must be presented in a meaningful ceremony, and it has to happen every 5 years. It doesn't have to happen, but it has to be 5 years or more that you can give it to them without being taxable to the employee. Publication 5137 and publication 535 has more details on some of these taxable fringe benefits we're talking about. But also know for length of service, you cannot give them cash, gift card, vacation, meals, lodging, theater, or sporting tickets, because they are dollar values that are assigned to those tangible gifts, and we can go back and tax them on that. The other thing is length of service does have dollar values that are assigned based on a one gift that's given or a average of multiple gifts given to your employees for that year. So make sure you are aware of those dollar values. Personal use of auto, it is excludable from our W-2s if it is business use. The employer may elect to not withhold federal income tax. It is not required to withhold. It is required to put in box 1, but you also must report in box 3 and 5, which is our Social Security Medicare, and you have to withhold that. The record keeping is the employee's responsibility. It is not the employer's responsibility. If they do not turn something into you, it is 100% taxable to them. Then they would have to take the deduction on their personal tax return at that time, which they never like to see that come through on the W-2. So make sure that you are getting the employee to document the beginning of the year and the end of the year odometer reading to make sure how many miles did we drive, and then give us what's personal and what's business use. So if you have an employee that tells you that they have 100% business use, that is not true. So just so you know, be prepared for that. So if they say 100% was business, don't tax me on anything, you need to have the documentation that states this, because then you can say, all right, we're not going to do it. But if an audit came about, the employee is now liable for picking up that income. If an employee tells you, oh, I'm pretty sure it's the same as last year, make sure you get that in writing document so that you can say, oh, we asked, you didn't deliver it, we did it the same as last year. And if they actually ask for an auto log, this might become as income to that employee also. Reminder that the drive to and from work is always personal use. The commute to and from work is taxable. So the method one, we have 3 methods for calculating personal use of auto, and we have a great toolkit on our Eide Bailly website about personal use of auto and some of the forms. But the commuting value method, we have an employer to allows employers to value an employee's personal commuting by $1.50 per one-way or $3 round trip. But you have to meet the 4 conditions. The vehicle is owned or leased by the employer. The employer, cannot require them. Like, they have to require them to drive to and from work, and that's normally more for like maybe advertising. Maybe they're going to different directions that they don't come into the office all the time. The employer has to have a written policy prohibiting the employee. They cannot use it for personal reasons. So that's why we're saying the commute in and back to work, so the $1.50 or the $3 should be their only personal. So they should be able to go from work to home, and then if they have to go to a store or to a school event, they have to take their own personal vehicle. They're not allowed to use the company vehicle. An employee cannot be a control employee. The most control employees are like board members, shareholders, top paid employees of the company is where you're coming in with your control employees. So you have to meet the 4 conditions to be able to do this method. The annual lease valuation method, most commonly used. You got to determine the fair market value of the car, and then you have to reevaluate that on the 5th year. Unless you are selling the vehicle or purchasing a new vehicle during that time frame, then you can prorate from one vehicle to the other halfway through the year. The IRS gives us annual lease value tables, and we use that to calculate the percentage then of personal miles driven and then the value of the employee's personal use. So this is something that you can use an Excel spreadsheet for, and we have some of those that we do the calculations for you. If the employer pays the gas, you have to add on additional 5.5 cents to this calculation. Remember, when you are doing this calculation, that you have to look to see if that employee has gone over the Social Security wage limit and or also have gone over the Medicare tax wage, the $200,000, because that would change the calculation of how we add that onto their W-2. So don't calculate Social Security tax if this is someone who's over the Social Security wage limit. All right, the cents per mile valuation. This has had the biggest change that has come through for personal use of auto. So the 2019 mileage rate is 58 cents per mile. We have not yet received the 2020 mileage rate. That usually comes very late in the year. We'll see, at least we haven't received it as of today. The following conditions have to be met for you to be able to use this method, and it is the vehicle has to be driven at least 10,000 miles annually, and then the fair market value of the vehicle when first put into use cannot exceed the luxury car value. We used to make so much fun of the IRS for this luxury car value because in previous years, it was the luxury car value was $15,900. And if you had a truck or SUV, it was $17,800. So the IRS must have understood we were laughing about them at this, what they consider luxury. And they increased even to last year. It had to happen late in the year. They increased it to 2018 went to $50,000 for a luxury car or truck. Both of them equal $50,000. In 2019, they raised it to $50,400 for what is a luxury vehicle. So they went from $15,000 to $17,000 to $50,000 for a luxury vehicle. All right, polling question number 2. What letter code is reported in box 12 for traditional 401k? All right, so the correct answer is D for the traditional 401k. The S is for simple, the AA is for a Roth, and the W is for HSA, for house savings account. So just to give you what the other codes were for. Group term life insurance. You know, the other thing I want to kind of go back to on that person use of auto, if you reimburse your employees more than what the IRS rate is, so if you reimburse them more than 58 cents, anything above the 58 cents becomes taxable to your employee. So just kind of know that also. Sometimes you're just trying to be a really great person, but the IRS is going to say that's taxable. So group term life insurance, taxable. Employees get to have anything over $50,000 included as W-2 income, but they allow it that anything that's below $50,000 is not taxable to the employee. So if your group term life insurance policy is $50,000, it does not need to be reported on the employee's W-2. But if it went to $60,000, now you have $10,000 that we have to, not the $10,000 itself, we have a calculation we have to go through, but we have a $10,000 value that we need to calculate to see what we put on that employee's W-2. It is based on your age as, what would your age be as of 12/31/19? So if your birthday's in December, you're going to be that age for the whole year of 2019 based on the tables that we're going to show you. 2% shareholder, just a reminder, it is 100% of the premium values, not this calculation. And dependent group term life, if the value is over $2,000. So we've had questions like, well, if I have a $2,000 policy on each one of my kids, and there's 3 kids and the full value is $6,000, it has to be over $2,000 on the individual child. So you could have 3 $2,000 policies and that's not going to be taxable, but if you put $6,000 on one child, then you know anything over, anything now that you've gone above $2,000, the whole thing is taxable. They don't get an exclusion like employees do for $50,000. The non-taxable part, if your group term life insurance, the beneficiary of the policy is the company, charitable organization, or a termed employee due to permanent disability, then it becomes not taxable to the individual. And then the coverage less than $50,000, and also the group term life, like I said, the dependent care, if it's less than $2,000, not reported on the W-2. Group term life is subject to federal, FICA, and state, but they are exempt from FUTA tax. And most states follow for SUTA also, so you just have to determine what state you're in. And then the value of this goes into the W-2, box 12, code C. The premium table that you use to do the calculation is out on the IRS publications. And if you have done this calculation before, this chart has not changed. Here is the formula down at the bottom, group term life coverage, minus the $50,000 that's excludable, and then you go across the rate factor. If the employee does do an employee after-tax deduction for group term life, you also want to take that into consideration before you do the calculation. Once you get the value, that's what's added back to your employee's W-2. We are seeing this be more frequent, that employers are doing it on every single payroll check versus doing the calculation at the end of the year. Supplemental tax rates, these remain the same. They changed previous year. Federal rate still at 22%. Federal tax, if it's over $1 million in wages, is 37%. And make sure you look to see what your states are, because every state has their own, or they decide not to have one at all. So make sure that you are checking to see, as we do the taxable fringe benefit valuation, what we need to put onto their payroll W-2s, that you are looking at your states as well as your federal. Gross up, we wanted to give you some calculations out here. So you have the slide deck, I believe that you guys could download this. Making sure that when you do a gross up, that means that the company is deciding to pay the taxes for the individual, which they are allowed to do. The employer can say, you know what, we're going to gross it up, we want to give them a benefit, we'll pay it. But just remember that what you give the employee for the value, it now becomes the net check, and you need to figure out what do we need to add as wages. So it's normally the amount of the payment. We got to take 100% minus the employee taxes, which on the screen is your federal, your FICA, your Medicare. Remember that you might have a state, so this thing is missing a state one. If an employee is over Social Security wage limit or a Medicare high earner, this formula will change also, so be conscious of that. Here is a few examples of a gift card where an employer pays the taxes. Like you said, the $100 gift cards at the bottom, we have to gross it up. The true value of the gift card is $142.15. if the employee is paying the tax, so we could have it where the employer gives them a gift card of 100, but they are going to input it as income. Things that you need to remember is you need to make sure you have a paycheck to withhold that FICA taxes from. So if you do this after the last payroll is done, you do not have anything to withhold from the employee because they do not have a net check. So gross wages, and then you come down to the formula where the FICA, Medicare, we just threw those in there for an example. Offset the gift card of 100, the net check is reduced by the $7.65. Here's a special situation calculation to help you. If your employees are over the Social Security wage limit, how do you do the formula? Because this ends up happening when you come to the end of the year. It could be that they are close to meeting it, but they're not quite there, but whatever you're giving them is going to put them over. So here's the formula on how to fix that. And then also the calculation of how the pay stub would look. All right, I'm ready for Jillian to take over the 1099 reporting part.
Hello, this is Jillian. Nice to be on with you all. I will note we're running a little long on time, so I will maybe try to shorten some of this up and get through what we can. All right, so we're just going to talk through some 1099 basics here, kind of a quick overview of 1099s. I'm going to talk quickly about employee versus independent contractor. We're going to go through the common types of 1099 forms that you'll most likely send and possibly as an individual or business receive. We'll go through quickly filing and correcting forms, some penalties, and then if we have time at the end, we'll just kind of talk through W-9 best practices and backup withholding and what that looks like. So real quickly, the 1099 or the information return was developed to help the IRS figure out what basically companies were deducting that other individuals who were receiving that income were not reporting to be taxed on. And so they called that a gap there, and they wanted to kind of cover some of that gap. 1099s are generally, at least mostly people think of the independent contractor receiving a 1099, but there are other reasons to receive one, such as interest, dividends, sales proceeds, on and on and on, which we will talk about today. So who needs to prepare 1099s? This would be a payer. So a payer would be the person that's taking the deduction on their books, or the business that's taking the deduction on the books, I should say. And they do include entities that don't pay tax, so nonprofits, governments, that sort of thing as well. A payer does not include someone who is not in the course of a traded business. So that would be like a personal payment. So if I'm paying someone personally to mow my lawn, I don't need to send them a 1099. But if I'm a business and I have someone mowing my lawn and I take that deduction, in that case, I should be preparing a 1099. A nominee or middleman also would need to prepare a 1099, and this would be if you received income that wasn't yours or wasn't all yours. You would want to prepare a 1099 to report that income to another person so that they can pick up their share. So the main example here would be maybe farmland owned by 4 siblings, and one of the brother receives the 1099 all in their name. And so then that brother can prepare 1099 to his siblings to show that their amounts that they should be reporting. So successor and predecessor reporting is something we'll also see, and that's when a company purchases or acquires another company. Those two entities can decide together if the successor is going to report all the income for the year, or if the predecessor is going to report and the successor is going to report for each amount that they had involved through the year. So who needs to receive a form? So now you know you probably have to prepare one, but who needs to receive one? Sole proprietors are the biggest example, but additionally we have to send them to partnerships. In most cases, we would not send a 1099 to a corporation, but there are special situations. There are a few listed here, but we'll hit on those as we go. LLPs would be, LLCs might be, depending on how they actually file their tax return. So that's when the W-9 is vital, because they can say, I'm an LLC, and if I was a sole proprietorship, I do need to receive a 1099. In the case that they're an LLC and they file as a corporation, for example, then they don't require one. And Texas entities do not require 1099s either. So general requirements for needing to prepare a 1099, all the things listed here, but $10 or more, royalties, interest, dividends, or retirement plan distributions, or $600 or more if you're paying rent, services, prizes and awards, healthcare payments, crop insurance, and the other income is one we'll talk about a little bit. 5,000 or more direct sales is listed here. And then any amount if you withhold, because withholding will need to be reported. and then $20,000 or more, or $200 more in transactions with a third party or payment card. So that would be for the credit card company or like a PayPal situation. And this is just a general list. Just want to note some things are included here, but these are the basics of things that would be required. I want to hit here on due dates as well, and I did find that I goofed up and I put, I don't know if you can see my mouse, but over here on the recipient side, that doesn't need to be there. That's just a duplicate of what's up here, but it is very important, so it might have just been a slip that I did intentionally. But forms are due to the recipient, the 1099 forms to recipients by January 31st. And this is very similar to the W-2. They're going to need to prepare their personal tax return, so or their corporate tax return, I suppose, or business tax return, depending on the entity receiving. But they're going to need to file that return, so they need all the information they can have in order to file that. There are a few exceptions as far as needing to send them to the recipient by February 18th, and that's only 1099B, 1099S, and 1099 miscellaneous for amounts in box 8 or 14. And we'll look at 8 and 14 as we go. But in general, always assume you have to get those to the recipients by January 31st. So if we skip over to due to the IRS, the rules changed last year, and 1099 miscellaneous with amounts in box 7, which is the non-employee compensation box, those need to be sent to the IRS by January 31st, and there's no extensions. So that's very similar to what Kate talked about with respect to W-2 filing. They're due the 31st, there's no exceptions, and certain penalties apply. We'll talk about those penalties in a bit. And then all the other forms, 1098, 1099 series, 3921, 22, and W-2G, those are all required to be filed with the IRS by February 28th if you file on paper, and electronically if you file March 31st. Just as a rehash on the first bullet there, the filing of January 31st is required whether you file on paper or electronic filing. So anything with box 7, just make sure you get it filed by the 31st of January. And then for the other forms, not the non-employee compensation, you can request a 30-day extension by filling out form 8909, and that'll give you a 30-day extension. But just a reminder, not on box 7. So I'm just going to quickly talk about an independent contractor versus employee. And I say quickly because we're super short on time here, but there's basically a 20 criteria right to control test that the IRS uses. And the main thing I want you to take away from this is that just come up with a reason on why they're an independent contractor versus an employee, and maybe make some sort of memo that you and the independent contractor review that proves that they are an independent contractor, so that if there ever is a situation where you get audited for that, you have a good basis for why you chose to make them an independent contractor, not because it was easier for you or not because you didn't want to pay the taxes, but real basic reasons here. And I'll give you some resources in a couple slides if you have want to do some research on that. But the importance of calling someone the correct classification is that if they're an employee, there would be withholding required, as we saw earlier. You have to do federal withholding on W-2 unless they're exempt. You also have to withhold Social Security and Medicare tax. If they're an employee, the employer pays a portion of that and the employee pays a portion. As an independent contractor, the contractor pays the whole amount. So it's important to classify that correctly. Also, a lot of the employment statutes, Fair Standards Labor Act, and other employee-related things only apply to employees, and they don't apply to contractors, such as minimum wage or sick leave or certain other things like that do not apply to independent contractors generally. So you, as an independent contractor, would be having to cover all of your own things, and in the case of it's supposed to be an employee, the employer would be on the hook for those. So basically, it can be expensive to misclassify. And I just wanted to say a little tidbit here that this is an older stat, but in 2010, the IRS started auditing randomly for people who might have misclassified. And so just, they are actually looking into that sort of thing. So make your memo and be prepared. Just real quickly here, the things that could be involved if you misclassify. You have to pay back federal taxes, including the employee's share. So that would be federal, FICA, and Medicare, probably all three. You have to pay any state taxes that you didn't pay, unemployment taxes. If there was an employee benefits, such as retirement, they will probably be part of that plan, and then you have to pay those benefits. And there would probably be requirements to amend your tax returns and the employee's tax returns, or the should have been employee's tax returns. which can be costly administratively for both of you. Here's some additional resources if you are in a case where you want to research that further. Would be publication 15, 15A, and 15B. Also, a good Google search will always get you somewhere. And feel free to reach out to us if you have questions. You guys have our emails and phone numbers. All right, polling question number 3. In what year did the IRS officials start conducting random audits of approximately 6,000 U.S. employers for employment tax compliance and proper work classification? All right, so quickly, some common types of 1099s. The basic one that most people will send would be the 1099 miscellaneous, and it reports things like rent, other income, definitely if you withhold tax on any of these payments. Non-employee compensation, which is the big one, pretty much all the things that you can see here. I'll go through box by box in a second, but it's important to code the box correctly on the 1099. So for example, if you pay someone rent, don't put it in the other income box, or don't put it in the non-employee box. The same as the other way around. If you paid someone other income, don't call it rent. That's important because the non-employee comp box obviously is a hot button, but the IRS is expecting that that person will pay Social Security and Medicare on that amount. So if it's not really supposed to be in that box, don't put it there because they'll be subject to that additional tax. Also, you only have to make payments in your regular course of business, which we talked about earlier. And for this box, most of it is $600 as a threshold, except for royalties, which are $10. And you don't use this form for payments to a corporation. If you're purchasing merchandise or telegram, cell phone, all of that stuff that's like more tangible. I will say on that, if you pay someone like a plumber $1,000 and they're coming to your business and they're doing plumbing as well as some parts, and you're paying for both, as a person who's going to pay this, put this information on 1099, you don't have to separate out the parts and labor. Even if they're separate on the invoice, you're paying this person, you can just all include it. If you have a great system that does separate it, you're allowed to, because you really only need to include the service portion of that, but you don't need to. They should be picking up all that income anyway. Don't really use this form for wages or travel allowances to employees. You don't have to do it for tax-exempt organizations and not for scholarships. This is obviously also not all-inclusive list. I'm just going to quickly talk through these boxes. We've got rents, $600 or more, which is box 1. Royalties, which would be $10 or more. And if you're paying surface royalties, then that would be considered a rent in the rent box. Other income is the box that's like everything else. So if you're giving prizes, not to your employees, of course, or you have a game show situation or a sweepstakes, there's lots of pretty much anything that should be reported that doesn't have a different box goes in this box 3. Box 5 is fishing boat proceeds. We've got the medical and healthcare is box 6. Crop insurance is box 10. So $600 or more proceeds you received. 14 is the gross proceeds paid to an attorney. And that one doesn't matter if you're a corporation or not. You still need to get that, send that to a corporation in that case. And then I left box 7 for the last. And that is the one that's non-employee compensation. So that would be your basic independent contractor relationship. You get fees or commissions or other compensation paid. So that would be like services to your plumber, snow removal, cleaning services, and things like accountants. So we're a partnership as Eide Bailly. So if anyone paid us more than $600, there should be a 1099 coming to us. Also, if you're doing advertising, if someone's building you a website, that would count. But if they're selling you pens with your logo, that would not count. It's just kind of keeping, again, along with the services versus the labor, or merchandise there. But yeah, all of these examples here, director's fees, subcontractors, DJs for your company party. There's a lot of things that could end up on the 1099 if you're not thinking, or that you might not be thinking about. So just make sure you're aware. I'll just talk about the 1099 interest here. This one reports basically interest income and any withholding that was on that, investment expenses, bond premium, market discount. Generally, these would come to you more often than you'd be sending them out unless you are a financial institution of some sort. So it's $10 or more would be when you generally receive that off of, say, your bank account or something. But if in your course of business you took a loan from someone and paid them $600 or more, you would use this form to report that interest. They're not required to be sent to corporations. Similar rules, tax-exempt organizations, and HSAs, IRAs, things like that. You don't have to file them for interest on an obligation issued by an individual. And then account numbers are generally required. If you have more than one account, for sure, the IRS just likes to see account numbers on there. So that's if you have a bank and you have 2 or 3 accounts that are earning interest, those account numbers should be listed. 1099 dividend reports dividends. So that's pretty basic here, just dividend distributions, non-dividends, federal income tax withholding. $10 or more paid in dividends would need to be required, or $600 or more as part of a liquidation. So if you receive dividends as part of a liquidation. Again, the IRS wants to see account numbers, and if you have more than one account, they require that. And then an S corp would use this form to distribute out accumulated earnings and profits. The other form I wanted to talk about is one that you'll most likely receive unless you're some sort of third-party network transaction processor. But the 1099-K is something that reports any payments made to you if you use a credit card company, PayPal, Square, something like that to process payments for you. So it will detail out those payments by month, and this is kind of the definitions from the instructions here, but basically if you have $20,000 or more and 200 or more transactions from a credit card company or similar, PayPal, etc., whatever you want to call those guys, third-party networks, then you would be receiving a 1099-K. There's a couple tricks with the 1099-K just to be aware of. One, gross payments will be reported. So if someone swipes a credit card and you have a restaurant and they put the tips and the sales tax on that card, that full amount will be reported to you, even though you're not going to pay tax on the taxes, sales taxes, or the tips. Those are handled differently. So you just need to make sure in your tax return that you are aware that that 1099-K might be more than your total income. Also, if you pay someone with a credit card, the information will be reported on a 1099-K, which means you don't need to report it on a 1099 miscellaneous. So if your plumber comes over and he has a Square payment system and you pay him with credit card, then that is no longer in your requirement to prepare a 1099 form. You can still pay or prepare a 1099 form if, for example, you paid both credit card and cash and you don't know which one you did, so you just want to report the whole thing. That plumber will just have more income reported on his 1099 miss and 1099-K than maybe he's actually reporting. And the IRS knows that that could be an issue also due to the sales tax and tips and things that are included there. They are aware that that's an issue. But this form is basically made to catch people who were selling things on eBay, more like a business and less like a garage sale, or other things where they're kind of skirting under the radar. This is kind of just a list of the other less common 1099 forms. We're running short on time, so we're going to keep on moving. So as we noted with the W-2, you have to file paper filing, or you are allowed to file paper filing if you have less than 250 forms. If you have more, you need to file electronically, and it is per form. So even if you have 270 W-2s and your 1099s are only 10, you can still file your 1099s by paper. Same with the type of 1099. If I have 280 miscellaneous forms, but I only have 10 interest, I can file my interest forms by paper, but I have to file my miss forms via electronically. These forms are machine read, so make sure they're legible if you're going to handwrite. Paper filing should include a 1096, which is the transmittal. I'll show that on the next page. Don't use any $ signs. Always mail the read originals. Do not send in copies. And mail them in a flat envelope. They don't like them folded because they are harder to machine read. So here's the copy of the 1096. It lists your basic information here, the number of forms, the amount of withholding you have, and then which form it is. So any type of 1099 form requires a different 1096 transmittal. So if you have interest, those would be on a separate one than your miscellaneous, for example. Electronic filing, so anything over 250 for the type of form. And the electronic filing is great because it gives you an extra 30 days to file, generally, except for in the case of the 1099 miscellaneous forms with Box 7. Also just want to mention really quickly that the IRS is looking into creating a separate form. I think it's going to be called 1099 NEC, but I'm not 100% sure. But that form it'll be available for 2020 year income, so not due in 2020, but due in 2021. And that form is likely looking like it will just be reporting that box 7 information on a separate form. So we'd have to file that form early by January 31st, and then the 1099 miscellaneous will all be due after. Hopefully that's how that works and it's nice and smooth. But that's just what's coming, possibly. Also, publication 1220 provides great information with respect to how to file electronically, and you do have to register to file the fire system. That application is right here, the 4419. And if you are looking to probably file more than the 250 forms, I would get on that sooner than later. It has to be filed 30 days before the due date. There are processes on Form 8508 if you cannot electronically file. Those also have to be done 45 days before the due date. So the sooner that you can get on that, the better as well. Quickly talk about some common errors. So not filing a form when one is needed, filing it late, filing on the wrong box or the wrong year, the wrong type. So if you filed interest income on other income on the miscellaneous box, for example, not reporting a taxpayer identification number or reporting it wrong, or possibly having the wrong name, the wrong taxpayer identification number. If you're filing by paper, not using Form 1096, and then wrong amounts or making entries that can't be machine read. I wanted to quickly just talk about, so there's 2 types of penalties for doing things wrong, which the things I kind of mentioned earlier, reporting the wrong taxpayer identification number, the wrong amounts. There's 2 types of penalties. What's under each type isn't necessarily important, but what is important to know is the amount. So this top due 01/2020 through 12/31/2020 are penalties. So not 30 days, $50, or not more than 30 days late, $50, and on up, the same penalties as the W-2s that were already discussed. The large businesses are over $5,000 or $5 million, sorry, and small businesses on this slide are less than $5 million. Either way, intentional regard has no limit to the amount here. I'm going to skip to the polling question real quick, and then I'll just talk about W-9s for anyone who wants to hang around, because it is 11:32. So when invalid or missing taxpayer identification number is present on 1099s, you're supposed to withhold at a certain percent, called backup withholding. What is that percent? Perfect. I'm just going to skip to the end again real quick for polling question number 5, and then I'll head backwards to review. So I just wanted to quickly touch on our year-end resource. We have a website, eidebailly.com/year-end, and on this website we have links to things like the personal use auto calculations that Angie mentioned. We have some year-end articles, things to talk about how to close your business and what things are required. We've got our 1099 and W-2 books, which we put together as part of this year-end webinar, and you'll all get those. I believe you get those via email, or at least a link to download them to your email after this webinar. Those have tons of information in them, and on this website you can also contact any of us if you happen to lose our contact information or the PowerPoint. But yeah, visit year-end for any questions you might have, and feel free to reach out. So again, you don't know this answer because we didn't talk about it, but what form requires semi-monthly, you to pay semi-monthly if you paid more than $50,000 in a year? Backup withholding is essentially what we're still talking about here.
And the results were 46% Form 941.
I believe those rules also apply. The answer was 945 because that's what we were going to talk about. So if you need to drop off because we are past time, feel free. I'm going to spend a couple minutes here real quick on W-9s, which are the forms that you request when you pay someone that will likely receive a 1099 at the end of the year, or to cover you and make sure that you don't need to send them a 1099 at the end of the year. So best practices would be to send a W-9 before you make any payment to a vendor. That way you're certain that you get a W-9 because you're withholding payments. Also, you can send an annual letter with the first payment of each year requesting an updated W-9 in case something changed with respect to that vendor. You can use a TIN verification program, which is similar to the Social Security Administration SSA name matching they've discussed earlier. One thing that was mentioned is use corporations as often as possible because generally you don't have to file a 1099 to a corporation, and also pay with a credit card because that 1099K takes over and you don't have to file a 1099 for payments made with a credit card in most cases. This is just what the W-9 looks like. You just have the person check what kind of entity they are so you know if you need to file a form for them or not. And it also asks for their federal ID number. If you do get an incorrect taxpayer identification number, the IRS will match that in their system, or if you file a 1099 without one, they'll send you a notice and they say you need to start backup withholding. Backup withholding is 24% of the amount paid. And if you get in a situation, you'll also likely get a penalty based on the fact that you filed an incorrect 1099. But this process can be pretty expensive. Here's just a quick example. If you paid someone $20,000 and didn't have their taxpayer identification number, you should have done backup withholding, which would have been at 24%, $4,800. And if you have late payments, penalties, and interest and such, you could be up to $5,550 in penalties that you'll have to pay. For this one person, you paid $20,000 to, so it can get pretty expensive. The 945 is the form at which you remit, or you show the IRS you've paid backup withholding, you remit that through the year, similar to how you make your 941 payments. And that, I just wanted to cover that real quickly before we go. We ran out of time for questions, but we will see those in the Q&A and get back to you guys. So thank you so much, Angie, Kate, and I appreciate you being on the call. Thanks, Amy.
You guys are most welcome. Thank you all so much for attending.